the fabulous Carrie Lou. Every year her session is the most popular. So come on up. And she's going to talk to us about, I think it was interesting that Christine said you're only as good as like your last, well, I'm over dramatizing, but the company that you were at is a big deal. And we work too hard to pick crappy companies. And so Carrie Lou is going to help make sure that the next gig that you guys land is an awesome, awesome company.
Stay on stage a second.
Oh, God.
We don't get a break, and I would like to apologize. I also don't want to let you go on a break because I want you to stay. I've worked so hard on this. It's going to be a great presentation. But stand up for a second, and let's give Latany and her team a standing ovation.
Oh, thank you, guys. Where's Claudia? Where's Claudia? Claudia! We love you! Amazing. Amazing. It's all her. It's all her.
Stay standing 1 second. I'm going to start the presentation with you standing, but
Oh.
I would just like to say thank you personally. I mean, this is a highlight of the year for so many of us, to feel like we can be ourselves, to feel like we can learn, to feel like we can connect and have people that are going to support us. So thank you for everything you guys have done to make this possible. Thank you.
You guys, love you.
Okay, stay standing if you have equity from somewhere you worked from. Okay, great. Now, stay standing if you do lots of personal investing. You like to trade stocks. Do you like to trade stocks? Keep standing. It's okay. Okay, now stay standing if you would consider yourself an investor and tell other people, I'm an investor. Awesome. You stand up. None of that like self-effacing. Oh, you think you're an investor. That's great. Okay. Look around us at these women who've said this. Thank you. I'm going to start my presentation now, and I need a clicker because the title of today is How to Think Like an Investor. And I will assert that every single one of you standing up who has equity is an investor. And in fact, you're investing more and with greater risk than most people who are professional investors because you get to make one choice at a time with 100% of the time that you have to dedicate to that company. Let's see if I can work a clicker. Okay, so thinking like an investor. Also, I'm going to cover CMO salary trends, and we're going to talk a little bit about equity and what you can negotiate for, because that's part of our power of investing our time. So I'm going to start first with the psychology of money, because I have all my slides going very quickly. Can we go back here? The psychology of money? Gonna stay? Okay, great. The psychology of money, because I have a confession to make. I'm obsessed with money. And I have another confession to make, which is that I have a lot of shame about that, because I'm Christian and because I really believe in Buddhist philosophies. And for both of those religions, which I consider myself deeply spiritual, money is an obstacle to enlightenment. Money is an obstacle into entering the gates of heaven. There is no greater shame in religion than being a rich person who indulges in your money. And I think this is particularly a challenge for women. Now, I'm telling you both about my obsession and my shame, and I will tell you, I think my shame is legitimate, and I think that my obsession is legitimate. I come from a long line of financial insecurity. My dad once told me, in all seriousness, Carrie Lou, you never know when you're going to have to flee the country with your gems sewn into your clothing. And I thought that might be irrelevant for my generation. But that's like passed on to him from our Polish ancestors. My great-grandfather who had to walk out of Poland because they wouldn't let him leave to try to get a boat walking through Germany to come to the United States. And then when he got here, he started a company. He was like the original capitalist in our family. He started a streetcar company, and he owned one streetcar that went this way, and his business partner owned the other streetcar that went the other way in downtown Milwaukee. And they opened up a little bank for Polish immigrants. And then the Great Depression came. And there were runs on the bank. And they lost almost everything they had. And they scraped everything they could together to sell everything and take all of their financial assets to pay off the people who had banked with them, to give the money back to their customers. And when I grew up as a kid, the Great Depression was a very real part of our life. My dad would talk about like you have to eat all the food on your plate. Some people can't eat any food. Like we used to save all of our tin cans and maybe you can use this. My dad has a lot of money and is very comfortable and stockpiles 2-gallon Pepsi bottles in his attic so that he can take them to California because you get 10 cents instead of 3 cents at the recycling center. And on my mom's side, she had an alcoholic father that they would have left if her mom could have made money. So I was raised with this like deep, intense need to make money to protect myself and others, and this commitment to being a woman who could be independent. I didn't want to like have to use the cash envelope that my mom was like, here's where the $2,000 is in case you have to run out of the house at some time and you need money. So money is this thing. And yet now that I've made a bunch of money, I have so much shame. I live in a nice house. Isn't that horrible? And so for this moment, for this presentation, I want us to take all that shame and all that baggage and I want to put it on the side and be like, how do we make the most money the fastest? Because that's the question that I want to ask us. And that's the question that the men are not ashamed to ask themselves and each other. And I'll tell you, almost all of the money information I have is from men because no women friends of mine have told me what their number is. What's our number in this room? To quit and hang out with our family and do our art projects. I don't know, right? We don't talk about that. You know what my guy friends at Atlassian told me? Exactly what their number was and how close they were and what my number should be. So I'm a little passionate. I believe that money equals freedom, choice, and impact, and that we shouldn't be ashamed because freedom, choice, and impact give us the ability to be a CEO and take huge risks, to make a social impact choice in your career that's a bad business move, to take time off, to take care of ailing parents and children, to help other people, to help yourself. And here's the problem. My dad is super interested in investing. He's a big personal investor. And my entire life, we had to watch the stock market open. We have to read the Wall Street Journal. We get a whole bunch of financial publications. And I am not interested. I'm telling him, boring. It's like not attractive to be into math in high school, so I hide my interest. I'm busy. I have a marketing job. I love creativity and writing and design. And so I focus on learning about marketing. And then I focus learning about tech. I know more than most of the engineers do about the entire tech infrastructure and how it all fit together in the last 20 or 30 years. But I didn't want to learn about investing. And that's a big obstacle for us, for both our careers, our personal wealth management, and I think for being CEOs. You know why marketers aren't CEOs? Because they don't know about the finances. And you know what they mostly talk about in the boardroom? The finances. Investors are at the top. If you work for a small startup, the people on your board, we're not going to get board seats in these tiny companies. It's only the investors. You become a public company, it's your investors, your public investors, the investment analysts that are making or breaking your future. I worked for a company that had a great product in a great market. As a chief market officer, I would have been like, we're on it. And we financed the company improperly. We had not taken on enough debt, and an activist investor threatened to take over the company because he could take over the company, take on debt, and buy us for free. If you don't get the finances right, there is no company. So, personal investing. I've been on this quest for the last 2 years to try to figure out how to pick the right company. Because I stumbled into a very great company, Atlassian, which we'll talk about, through friends and colleagues that I'd worked with before. And then after that, I took a Series C CMO role for a company that was social impact, close to my heart, referred by a board member, cool company, bad finances. And it was a 1-year dud that was really disappointing. And so I wanted to be like, how do you pick the next Atlassian? What do we do to find them? So I went out, I interviewed all these investors, I've interviewed all these different people, and I'm going to share with you my takeaways, which are going to sound somewhat pedantic because it's a core asset of things we kind of know, but that in the moment, and I would assert, maybe not you guys, but me as a woman, I orient more towards my feelings than towards, am I going to make good money here? I orient towards, do I like the people? Am I interested in the product? Is this kind of a cool, hip place that feels like me? And what if we were like, okay, that's great. Let's put that here. And then also, how much money am I going to make? So, growth. There's a tale of two stories. I'm okay. These are two, this is the moment I decided to leave Oracle. I could take a job at Oracle or I could take a job at Atlassian. And I had a great job at Oracle. I was running awareness advertising. I had 40 to 80 million dollars a year. I was doing global airports. I flew to LA to read movie scripts. I did all our sports marketing for Oracle Team USA and the Warriors Arena. But I thought that the people at Atlassian were more elite and going places faster. And the difference in my equity, had I continued to work at Oracle or worked at Atlassian, was a 10x difference. And I will tell you, I did not work 10 times harder. Let's keep going. Also, I mean, I guess I'm going to leave you there for one more other second. The other thing I'll say is if you have equity, you are an investor because you need to decide, do you hold it? Do you sell it? When do you sell it? How are you going to handle your tax consequences? And those things have really big ramifications. So, a tale of two stories at Atlassian. I had a peer who actually advised me on how much I should negotiate for my equity, which was the biggest gift anyone has ever given me. And he had had a bad experience at a startup where he had like $1 million, and then before the lockup ended, it had gone down to 200K, and he felt this like horrible investor regret of having held on to his equity too long. So he would sell his Atlassian stock every single day. He vested it. And I kept holding mine and kind of diversified, and I would sell some, but I've held a lot, and I've like, enjoyed the benefits of that 10x growth in a way that he hasn't. And he's the one who told me about his number. And the secret that I didn't tell him was that my investment strategy resulted in different outcomes than his. So, how not to pick it, we talked about that a little bit. You could be really careful about just liking the people in the market. There's a lot more to it. We really need to look at the core fundamental metrics, which I think start with growth, because I think growth is the most important differentiator of how much money you're going to make. When I was at Oracle, my team grew like a third, and I got a little promotion. And when I was at Oracle, my team 6x'd in like 3.5 years. And the promotions and the impact that I had were so massive. The opportunities I had were so massive. So picking great companies. Well, I really have trouble with these slides. I'm sorry. The first ones are easy. This is what we've talked about the whole time, picking the market. So these VCs, I wanted to go to the VCs and be like, okay, I'm an advisor now. I only want to pick the best companies and work for them. Teach me all about the financial metrics analysis. And they all came back to me and said, well, first, I start with the market. Is this a good market that's going to grow a lot? And then I go on to the customers. Do they really need this product? Everything we've been talking about here is the core starting fundamentals of investing. So, first, picking the market. Is it a big market? Is it a compelling market? I have a quick story on picking the market because one of the most influential books that I read as a new graduate was The Millionaire Next Door. I was obsessed with money. I wanted to make money. So I read The Millionaire Next Door. Oh, now I'm showing the wrong slide. And in The Millionaire Next Door, they talk about the difference in growth in industries. And the difference in growth in industries, so the best oil and gas company at the time uh, made like, I don't know, 30 to 40% profit. And the very best antique store at the time made 0 to 2% profit. So if you're at the worst oil and gas company, you might make 30%. And if you're at the very best antique store, you might make 2%. And it reinforced to me, I love antiques. I would love to work in antiques. But if I want to make money, I better go work in oil and gas. And so I picked technology, a great place to make money. And I've followed it through into B2B, and I've followed it through into SaaS, and I'm following it through now into hyper growth and product led growth. Here's the Deloitte Fast 500. Now, you can't see the stat, but software and SaaS makes up the bulk of their fastest growing companies list here. And kind of going on to the next category, I'm going to have to remember what's under the first. I think it's hardware related is under the first. The 3-year median percentage growth rate by industry. And so if you want to make money, you would go into industries that are growing the fastest, because potentially even the worst performer in that segment will grow faster. And we know this intuitively. Who wants to work in on-premise backup software now, right? Like, Christine and I were having a debate about the time she was like, cloud is the future. And they're like, no fucking way. I worked for Larry Ellison when for 10 years he continued to assert that cloud wasn't the way. But as technologists, we have more opportunities than most personal investors to understand what the trends are and to participate in them, either through our time by picking the right company, or through our investments with one another in companies, uh, or other vehicles that we pick as we become more and more sophisticated. So we have the product market fit that we talked about. We talked a little bit about growth. Another component of growth that came up for me with a recruiter, I was talking about a company that I was really interested in as an advisory. And he was like, oh, what a boring company. It's taken them like 15 years to get to 100 million. Like, they don't really have momentum. It shows that they don't really have, they don't really have it all together, right? So I wish there was this checklist, because I'm an A student. Show me how it works. I will learn the process, and then I will do it the right way every time. And what drives me insane about investing is there's no such linear to do, right? There's this thing like, how's the growth? And I had another slide in here that I think we skipped. The rule of 40, right, takes growth plus your profitability into account together to show how successful it is. And this, how fast are you moving to get to 100 million, is another indicator that they have such significant momentum that it could be a really strong growth play for you, and financial return play for you. Warnings. When I was a little kid and we would watch TV, my dad, who you hear about a lot in this presentation, would make us repeat after him after bad commercials that seemed disingenuous. Kids, say after me. People will lie to you for money. And then we'd all say, people will lie to you for money. And then we'd be like, my dad, he's so crazy. The gems thing, the money thing. Whew. And I will tell you, CEOs will for sure lie to you to get you on their team. They are professional bluffers. They go out and in fact, I was working for this one Series A CEO who is the perfect CEO for raising money. Handsome, well-educated, charming. Had worked on Wall Street, so he spoke financial. The company was falling apart, is imploding. There was no product. They hadn't found product market fit. They were flip-flopping around between different industries, and he was just kept raising money because he talked the talk and walks the walk. And been sold by CEOs or gotten into advisories where they're like, we're growing 80% a year. We're growing 100% a year. It's amazing. And then you go in and you unpack all the boxes in marketing and you're like, whoa, their organic growth flatlined 6 months ago. And only 30% of their sales reps are making quota. And when you look at their monthly ARR, they were kind of growing like that at the beginning of the year, and then we're kind of going like this. So as you pick companies, it's really important to understand for these things you're looking for: growth, net dollar retention, profitability. Some of your best assets are either doing research to the degree you can, or knowing people on the inside who can provide you real feedback that's in addition to what they want the outside world to believe. And I guess those are some of the things. How many people are making their sales quota? How is their organic traffic doing? And what do the real month by months look like? The next thing that I was surprised to hear from the VCs, although I shouldn't be, and again, back to Chief Market Officer, is how much VCs research the customers of a company before investing. And he was like, as a CMO, you probably won't have this opportunity, but we won't do an investment deal without interviewing 10 to 30 customers that we talk to through some of those investment services like GLG and these people that call us for a 1-hour consultation. So before taking a CMO job and believing a company about their fantastic traction and growth, it makes a lot of sense to talk to their customers and look at metrics like net dollar retention. And so, net dollar retention is a metric that takes into account how much a customer is paying you, how much churn there is, and then how much customer growth there is. And so, 100 would be one customer stays and pays the exact same amount the next year, or 160, where Snowflake was when they IPO'd, which is the very top of the line, is such an amazing net dollar retention that, like, if they didn't even get any more customers all that year, they would have 160% revenue the next year. That's the kind of company that's going to make you money. And so here are some metrics about best in class net dollar retention, great and good. Now, these are B2B, and I think they're B2B SaaS. This is from Atlassian financial analysis from January. Consumer is more like 90 to 110 or something because there's a lot more churn. So again, it's about knowing the metrics that make sense for your market. Again, with the people who lie to you for money. How many people have talked to a seed founder or an A founder who's like, we're going to make so much money? Like, you have to leave your stable job to come to this company because this is going to be the next Snowflake. We know that, right? And Shelly and I have talked about this a lot because Shelly got stuck in some Series A's, like this Series A loop. And another really prominent, or B's, A's and B's, another prominent CMO I know talks about it as her like sad A period, where she just kind of kept circling into A's and they kept like flailing, and then she couldn't get out of this A's momentum. You could do great in seeds and A's. The president of Atlassian, my friend Jay Simons, who was my boss, joined Atlassian at 20 million in revenue. And he stayed for 10 years and is now a very wealthy man and a venture capitalist. So he made a great choice. Of note to the last slide, he made it because he kept hearing from our customers at the company we were working for how much they loved Atlassian. So after having real market feedback, he joined a $20 million company that went on to be a many billion-dollar company. But there's a lot of risk in smaller companies. And as an investor, one of the things you often do is diversify your portfolio. Maybe you have 60% in stock and 40% in bonds or something. I don't know what your philosophy is. My dad's like against bonds, but that's for our dinner table. And so when you're making a choice with your career, a Series A is a lot riskier than a Series B, than a Series C, than a Series D. And I'll just tell you, like, for myself, so I am not an active CMO right now. I'm advising companies. I needed a little bit more time and flexibility given some things going on in my life. And I've decided that a sweet spot for me is kind of C and D, like somewhere maybe 40 million and up, where I feel like they have enough time, that they have real market traction. They have like started to bring on professional people that know how to do their job. They're trying to scale, and yet you're still far enough away from the IPO where there's space there to have a big multiplier. But it's risky. And so again, thinking as investors, we're making way more risky decisions than any VC. A VC gets to pick 4 or 5 or 8 or 10 investments. And if you talk to VCs, one of the things they say is that they'll pick 10 and only 2 of them will pay off the fund. Or, they'll pick 20 or 30 and 2 of them will pick off the fund. Nora was telling me yesterday she thought about her career as 4 lottery tickets. She had accomplished great things and had 4 lottery tickets left to scratch off. And so each of those decisions was so critical because so much of the money that we have the potential to make is not actually our salary. It's really our equity and our future opportunity cost is the wrong word, but opportunity to make more money. The choices you make now absolutely influence the board seat that you can get, or the next CEO job that you can get, or the quality of the company that you can get next. And so it's not to be taken lightly. Not that you are, but sometimes I was like, but this sounds so interesting. I really like the people. So the last thing that surprised me about the investors, because again, I wanted a financial analysis. Secretly, I want to still go back and be an investment banker. That's why I'm wearing this dress. Do I look the part? Yes. I got to be on a call yesterday with Morgan Stanley and talk about some institutional investors for a pre-IPO company, and I was like I want to be with them. I want to learn more. It's so interesting because I think it's such a big part of the education I didn't get trying to be a top marketer or a top technologist. So the last thing that investors use um, is following along on people they think are smarter than them. So for us, this might mean in the VC world, and I know this is very VC oriented instead of PE or public, and I apologize for that. I think we can translate some of the things, but some of my focus lately has been more in the VC world, that they look for who have been most recent significant venture capitalists that have invested. And for VCs, if a Sequoia or an Andreessen or an Excel has invested, they trust their judgment somewhat, as we might as CMOs who get to choose what company would we work for next. It's really reasonable to use smart people that you know, either investors or people on the inside or people who are experts in the industry to help pick those companies. And I'm thinking about an advisory, and they're a partner of Denise's at Snowflake. And I'm like, Denise, what do you think about this company? And her judgment is probably better than all of the financial analysis I can do with their CEO on these private company, the data that I'd have access to. So I'll tell you what's next. Timing. Okay, everything's about timing. I made a huge mistake earlier this year and bought some Zoom at the wrong moment. I was like, this is great. It's on its way down. It's such a deal. And then it just kept going down. And I'm like kind of like sitting on it, waiting for it to go up, but I know I need to cut my losses. And this is the same that's true for having a job. And we talked about this. When is it the right time to leave a job? A man would be like, fuck this, we're not gonna make money. I'm out. And a woman's like, but I really like the team. I've built this group of people. They're relying on me. I'm so loyal. Everyone's counting on me. I won't be able to look myself in the face if I leave them. You know what happens? 2 weeks later, when something else goes wrong in the finances, you're fired. They don't feel that way about you. Great, you hired good people? Awesome. I bet they can run this ship without you. Maybe we can save on your salary. We need to make money here. We could want to make money too. It's not shameful. I would assert that the women in this room have the chance to make a ton of money, invest it. I hope that we have an investing club at some point, if you're interested. And then do amazing social impact things if they want, or live in nice houses and go on nice vacations if they want, or take care of people that they want to take care of if they want, or spend it frivolously on beautiful things because they worked so hard for it. Nora was saying that someone that's on a board was like, I hate this board, but every time I said in a meeting, I'm like, one more trip to the Bahamas. So we talked a little bit about cutting our losses. Sometimes it's time to get out. You need to have take into consideration the opportunity cost to your career of both not making money then and also what impacts it can have on the next jobs you have. If you sit at a company that is struggling because you really care about your team and you've really committed to these people, you might have a bad story to tell when a recruiter says, how much did you grow the company? And you're like, well, there were all these problems, but I stayed. Okay, negotiating your salary. So as investors, we get to invest our time, and our time is worth a lot. And the first part of your salary is your salary and bonus. And this is easy because almost everyone has a salary and bonus at every level. I've monged a bunch of data together here, some benchmark data that I got illicitly from places I'm not allowed to quote, and our own data survey, which I've checked it against. And I'll put a whole bunch of different like star subfoots that some people are above and below, and there's difference between private equity and venture capital and public and private and size and how long you've been there. But roughly, CMOs are making 250 to 400, in the upper end 600, 500 to 800. There's kind of this line. I wanted data because no one would talk to me about the money. And I always wanted to know, how much should I ask for and what should I really negotiate? And these bonuses are kind of interesting to me. These ranges were consistent on our data with the two other data sources that I got from venture capitalists. And it's interesting that they're kind of a small percentage. Salespeople make so much because they put a lot on the line for the revenue number. And if we're really going to own revenue and we think we can hit it, we should be asking for bigger bonus percentages and putting more money in there. The next thing we're going to talk a little bit about is separation agreements, because we know the metrics about how long you stay in the jobs, and no one wants to have this conversation up front. Like, you've hired me, I'm so happy to be here. Let's talk about if you fire me when I don't do a good job, how much you want to pay me. No, we don't want to talk about that, but it's a real thing. And there's actually a lot in here that can be negotiated. So our data was a little all over the place, but I think more than 50% of people had a 3-month or longer separation agreement. A fair number of people had 6 to 9 month agreements. And there's also other things you can negotiate. So you can negotiate uh, your partial bonus, which is a really big deal depending on how big your bonus is. I had a great girlfriend CMO who was fired at her 11-month and 15-day mark and not given her bonus. Your healthcare, you can negotiate how long the healthcare. Sometimes you can have a 3-month bonus, but a 6-month healthcare. Note, if you make your last day, if you get to choose your last day and you choose it on the first day of the next month, you get the whole month. So there's some things to think about there. I also talked to one CMO who I met here, not this time, but another time, who had negotiated that if she was fired in less than 1 year, she got 1 month of each of her equity vesting for the months that she'd been there, basically erasing her cliff. So there's a lot there that makes sense to maybe have and put in place. So most vesting agreements are a 4-year vest with a 1-year cliff. So if you don't make it to 1 year, you don't get any of the first year. And she was in a significant enough CMO that she said, if you fire me at 9 months or 11 months and 15 days, I want 11 months of my equity. I didn't even know you could ask for that. Oh, Megan. Yeah.
Hi, I'm Megan Meisenberg. I negotiated with my current contract the first year. If I was I'm now been there 2.5 years, but if I was terminated within the first year, I would vest the first year fully, because I didn't want stress about coming up against the year, and just thought, nope, you work so hard in the first year to build your team strategy, like you need to be compensated for that. I'm not going to leave early, so you're not. It's still a benefit to them because you don't get anything unless you're there for a year, but you don't get anything if the 11 months, 15 days, or whatever.
Just to repeat for people online, Megan Eisenberg of Chip Action said that she had negotiated for a whole year of her equity where she could be terminated in the first year.
Hi, Kathleen Delaney. Question, when you were looking at this, did you see any difference between PE, VC, or public?
We will follow up with you on that because we have it, but it wasn't really statistically significant. So the audience was CMOs and some VPs and some big companies. So I didn't actually do the breakdown for the separation agreements of PEs. Do you think that there's a big difference that PEs negotiate for less?
Mm-hmm. All right, and they have told me, so I don't have a separation agreement. My last 2 gigs, I had negotiated separation agreements. One moved me across the country, and I'm like, dude, you're not moving me and my family, and then telling me to go pound sand. Thoma Bravo says it's not market for PE. They think that's more a public company. That was my response as well, and negotiated more equity on top of that. But I just was curious.
I can look at our data. And Latny and I didn't agree on what we would do with the data to publish it yet. So PE, does PE do it? I would assert that everything is negotiable. And that, so I took this job, the job that was not financially viable, had just taken on a PE investment, and they wanted to sell me on this equity arrangement that was like tiered by achievements and like valuations. And I didn't need the job. They needed me way more than I needed them. And I just said, no, like, no, I won't take the job with this funny arrangement. I can't value it properly to understand if this is a fair payment for what I expect for this role. And they were like, oh, I don't know. We can't do it. That's what the PE says. And I was like, well, that's too bad. I have a lot of opportunities. Got to go. And they came back to me and they gave it to me as like a straight percentage. And actually, it turned out to be a big issue because the CFO, who had only worked for public companies, had not negotiated his package well at all with any VC level things. And it became this big source of conflict when we went into financial crisis. And I was like, great, I've got it all set up, it's clean. So I think it's negotiable. It's a sense of power, right? If you want them more than they want you, you're going to take what they give you. And sometimes that could be a good thing. Like if we go back to Atlassian, if they had been like, no, we're not going to give you a separation agreement, but we're going to give you all the stock, I should have said yes. But I think it's always best to have multiple different options. And I also think I'm struggling with this, guys. I feel like our emotions sometimes work against us. You like get so emotionally connected to a job before you start it, and you're not thinking of it as an investor. Like, hey, I have $100,000, $500,000, $3 million that I'm going to put into one of these three companies. Which of these is going to give me the best return for the least amount of work or the most pleasure plus return?
Uh, oh, I just wanted to add to that, that cliff vesting period. Make sure that you get accelerated vesting because the same exact thing could happen to you. You work for 10 months, your company gets acquired, and you don't have a single trigger or a double trigger. That's a big one. Successfully negotiated that 25% for the first year of a 4-year vesting of that cliff to erase it. The other question I'm curious about is um, looking at non-competes and how they correlate with separation agreements.
Oh, that's a good question. We didn't
So
dig into non-competes.
they should
I've
be
often lived in California where non-competes are difficult to
to enforce.
enforce.
But if they're
But
in an employment agreement, they're a little bit easier. But fortunately, some executives that I work with on my team, we all got together and said, if you want a 1-year non-compete, we want a 1-year severance. It has to be equal. So just something to consider.
I like that idea. That's pretty good. These are some of the stats from everyone who completed it. We can go back to the equity percentages, but about 25% of people have early exercise. So I don't know how many people in here have early exercise or have used early exercise. Okay, just a couple. So the concept of early exercise is when you're granted the shares, you can pay for them then and exercise them at that grant price, which means you have no tax consequence and you own those shares initially until the time when they vest, then you really own them. You kind of own them in honor. And if you leave the company, they have to pay you back that cash without interest, which kind of sucks. But it's a tax benefit because you pay the capital gains on the increase, which is a smaller percentage than the income tax, which would be the gain between what it was granted at and what you exercised it at. Now, there's some coming legislation with the Biden administration that, depending on what your salary is going to kind of close off some of that gap. But I ended up with an early exercise at Atlassian because someone told me to do it that I trusted, and it turned out to be really fruitful, and I didn't even know it existed. And so part of this presentation is sharing with you all the secrets that took me a lot of pain to find out and make me a better investor of my money and time. The second one is extended exercise, which is bizarre because it's like the exact opposite end of the spectrum. It's the ability to not exercise your options until maybe 5 years, 7 years, 10 years after. And the benefit of this is, say you go for one of these A or seed companies, you don't actually know if it's going to be good. So you might not want to put down several $100,000 or more if it has like an overvalued round. You want to wait and see until after it IPOs, and then you exercise, sell, and pay off the taxes all at once. And so I've had a hard time getting this one negotiated as an advisor. I don't know, Nora, boards are mostly 10 years to exercise, I think. And a lot of small companies that I've worked for really resist the extended exercise, but it's another vehicle for you to understand how to use. I see, Megan, you're nodding. Do you have an extended exercise?
About 80% of the companies I advise, I can get 5 years, but not all of them. Sometimes they're like, nope, we don't do that for anyone.
Someone just told me that one that I was trying to get it for, it said that Andreessen Horowitz is like, no way. And I'm like, everything's negotiable. Okay, so the next thing is something I just learned about this year, which is promissory or cashless. So I was advising a company, my attorney, who I love, is like, hey, why don't you just ask for a promissory note? So I got a bunch of stock, and basically you can promise to pay for that stock in the future and get basically what's a loan from the company to buy your stock for you at that pre-purchase price without paying them any money. And you have to pay them a small amount of interest. I think I'm paying like between half a percentage and a percentage. But all that money that I'm getting, I'm investing in other things. And like, it's been a fantastic several years for tech, right? Just the QQQ index, I think it's up like 40%. And so if I can make 40% a year on the same money that I'm making, hopefully 6 or 10x on with this loan at this startup, that's like, let's make more money faster. I don't have to do any work. I just like let my money make money. And I'm starting to see that like that's the secret. Like the secret of super wealthy men is not that they're working harder than us. They're not working harder than us at all. They're looking for how to be lazier and make more money. How can I get to the Bahamas? How can I play golf? And how can I like go out for happy hour and make, I don't know, 5 million, 10 million, 100 million? Like we could think this way too without shame. Okay, change of control. We were just talking about that. Single trigger if the company is acquired or if you get fired. I'm actually not an expert on single trigger, but then you would accelerate your vesting of options. And double trigger is generally if the company is acquired and then you are fired. So two things happen. It triggers the accelerated vesting of your stock. And I've advised a couple of prominent CMOs who have not negotiated for this. And I have fought with them about that choice. And they're like, but I really love the company and I don't want the CEO to think that I'm greedy. I've been acquired 6 times. And I'm looking at April because I think she said 6 or 7. How many times have you been acquired? 6 times. Okay, we're the 6 times club. When you've been acquired 6 times, you would not take a job without an acceleration. It can happen to public companies. Speak on the microphone.
I just said it can also happen if you're at a public company. So I went to a public company and it was taken private by Thoma Bravo. Anyway, sorry. And they gutted everything. And I had a double trigger and I vested all my stock after working there for a year. And I was devastated, but at least I was protected. So don't look over it if you're at a public company.
Mm-hmm. I think these are important. Maria.
My steps. It's okay. I feel like we're talking about this like when you take a job. Generally people know this about me. I consider it a negotiation every day that I'm at the company, and you can change your employment contract the same way they can change yours, right? So if you don't have these things, that doesn't mean that that's not what you can have. You don't have to take the next job. You can negotiate every single day. And you don't want to do it every day, obviously, but I feel like I'm somebody who's often underestimated. I come in, I make some change, I'm going to renegotiate for something higher and then continue to do so. So I think it's like, we don't have to think of this list as like for my next job. I think we can make a list and say, hey, what do I need to talk to them about next week?
Mm-hmm. Now, you know why Maria is my like favorite badass of the week? Because I heard that she said, my CEO needs me more than I need him, which is why she can negotiate her CEO. You said it to your CEO. She did say it to her CEO, right? You need me more than I need you.
It's busy, right? Like there is a demand, a supply issue for good CMOs. That is why we can demand this. This is not greedy. This is supply meeting demand. This is how economics work.
So I'm going to put this up because we skipped over it and it's kind of important. What are the percentages that are available at different companies? And someday I would love to do this presentation again and have another one that's like, hey, for advising, and another one that's like, hey, for board, because I feel naked in the wild when I try to figure out like what percentage should I ask for. And I think I've spent 6 months trying to get this list together for you guys that looks kind of like wanky, text layouted, right? But at the smaller companies, you can get anywhere from 0.75% to 1.5 or 2% at a SaaS B2B company. Let's 50 to 200 million, it comes down, right? You can own more when it's smaller, and then as it gets bigger, you get less and less and less. And by the time you get to over 200 million, and I'm sorry about the way it's laying out here. We'll share the slides. By the time you get to over 200 million, it's not really about percentages. People aren't thinking that way. It's about total value. And even at smaller companies with really high valuations, they might talk about it at total value. And so, for like a smaller company CMO, it might be somewhere in the 500K to $2, $3, $4 million range. I've put on here the outliers just to let us know, like, holy shit, someone at a 50 to $200 million company has a $15 million package. Wow, that's awesome. You know what that makes me think? That's an experienced CMO who's done a really good job, who's making a strategic decision in her career or his career. It's a him. It's probably a him. Um, and negotiated well, right? So it's kind of helpful to like know what the playing field is. And then the only other footnote I want to put here is every time I see this stuff, I'm really mean to myself. I'm like, oh man, I'm such a bad negotiator. Oh, like I didn't really go for that as hard as I could have. And I talk to myself with mean words that maybe you've experienced before, comparing myself to others. And so what I want to challenge us to do is not compare ourselves to others, but just to see the data objectively and try to be less emotional and use it as an input. Because there are absolutely times when you should take a job with a lesser equity percentage. Maybe it's a great brand. Maybe it's a great career growth for you. Maybe you're moving into a COO role and you're getting two different things that are going to propel you forward. So these are just data points that you should use objectively, like an investor would look objectively at data, not as a self-critical woman would to evaluate her own beauty versus someone else in a more stylish dress.
So back to the question Marie had asked in the last session about why would you want to be a CEO? I can make good money as a CMO. My backstory is very similar to yours in terms of like, I got to have money to protect, right? To protect. And you can make a hell of a lot more money as a CEO. So these numbers, and it's only it's equity. Nobody cares about anything but equity. But those CEO equities are going to go from the kind of 4 to 6% at the low end, 6 to 8 average on up to 10 or 12 for the ones that really negotiate hard. And it's still all the same. If it's at a small company, you're still likely to get bought. You're still, right? The risk is high, but it's no higher than if you're the CMO than you are the CEO. The risk is still high. And you can make in 2 years what it would take you 20 or 40 to make working your ass off as a CMO. So if money's a driver, and you're still willing to work really hard, that can be a reason, not the only reason, but a reason to go for that CEO job. I'll repeat it.
So the question in the audience is about it's less risk. It feels less risky to be a CMO. And I will assert, so I have a shameful admission. I don't think I'm going to be a CEO. I don't know that I really want that. There's trade-offs in my life. And I'm like so in awe and amazed. I probably shouldn't shut it down, as Coco would say. Okay. I just want to, admit these things that happen in our body that we should say, like, I don't know that like I should listen to that voice that's talking to me. But the risk and the reward, it is risky, except even women who have like kind of like meh CEOships, then go on to get better stuff. Like if you're the best CMO 5 times in a row, you actually might get less board seats than someone who took a risk on a COO or a CEO job, because they're going to think you know more about how to run the whole company. And who is the woman who we talked about earlier? She's like a phenomenal board member, Elisa Steele. She was the CMO of Yahoo. Okay, I'm not going to go into the story. I'm just going to say she was a phenomenal CMO, and then she had kind of like a meh CEO. I forget, Lithium, Jive. She was at Jive. She was kind of like a meh CEO, but she understood how to be a CEO. And that CEO-ness has taken her to fantastic boards. I mean, she has a phenomenal career that is very admirable. And I think that risk, which you take, maybe pays off in that first time period of the job, but I actually think it also pays off in the next 10 or 15 or 20 years, depending on how much appetite you have to keep going.
First of all, this was awesome. My hugest takeaway is, oh my God, I forgot, Christine. My biggest takeaway from this is there's this huge game going on, and there's all these coaches that know all the rules. And so many women I see go in to play Wimbledon tennis and don't even know the rules or what coach to have, and they don't even have a box of their people. I was on this, it doesn't matter if I'm on it still, but I was on a board. We had a male CEO. We had all these advisors, lawyers, there's compensation consultants that were advising him at every single aspect of the package. We ended up swapping CEOs. The new one happened to be a female. We're the board and we're saying, hey, here's your offer. And we were waiting, and she didn't come back, and she didn't have an advisor. So I'm the only woman on the board, and I said, you know what? Should we just whisper in her ear? Go get an advisor to negotiate on your behalf. And they said, no, we represent the investors. It's in our best interest to pay. If she'll take less, give her less, because then there's more for the, yes. And it was everything I could do because I couldn't breach confidentiality. So the biggest thing I'm taking from this is use your network. There are advisors when you get bought by Thoma Bravo. There are advisors that tell you what Thoma Bravo pays, what you can negotiate for. And most of the people will tell you, oh, no, this is a standard package. I was doing a board. It was a late stage venture. And I just assumed they give all the board members the same as they do in a public company. But I called a friend. Thank God I phoned a friend. And they were going to give me 7 bips. And I said, what do you get? And they said 21. I was like, fuck. I go back and I said, hey, this is what I want. And you guys really want me, and I'm really good at this. And then they said, well, we really can't. But I said, well, could you take it to the board? He took it to the board, and I got it. So you can do this, but I got advice from someone before me. So I think that's the biggest takeaway I got is there's this whole game. If you choose not to know the rules, that's your problem.
And
As
I want to be
usual. Bam.
empathetic because when I took my Atlassian job, I didn't have a network of people to call. I called some people I knew at the company, and Lord help them, they helped me. And then I took my next CMO job, and I didn't really have a great network of CMOs then either. I kind of like talked to some recruiters that I'd been really nice to and got some data that's like some of the stuff that's behind here. And so it takes a lot of time. Like I joined this group in part to get this kind of data. And I joined like 4 or 5 groups to figure out which one is the best. And then I nurture relationships. Like I was telling someone last night that whenever I see someone I know speaking at a conference, I like go and sit in the audience and kind of wave, or if it's a Zoom, I put my video on so they feel supported so that I have more connections, because you really need them to know you. I think that Christina said it's not what you do, it's who knows you. Like when you get placed on a board, it's probably going to be because your CEO or some other top executive recommended you. I almost stopped returning recruiters' phone calls, not because I don't love Kate, but just because I felt like at some point I was just like one of a group. It was like it was going to go with someone they knew or someone an insider or someone that had worked with someone before, which it should. And if you don't know anyone at the company and you don't have any connection, it's really hard. And again, to come full circle to this investment thing, after everything I've learned about all this data, the net dollar retention and the growth, I think our number one investment tool is what we know. I think it's who we know and what we know, and background checking the market, background checking the people, looking into the growth, trying to understand the whole context of the market. Sorry, we were just finishing on the other things you can negotiate. So some people negotiate for first class in a company where they don't get first class. Some people are moving. Is there anything else we forgot that's really important that you guys negotiated?
So my first CMO job, I had a 4-month-old and 2 kids at home, and it was in New York, and I was in the Bay Area, and I negotiated $1,000 stipend for every business trip so I could bring someone with me so I could nurse until she was 1 year old.
That's a great one.
Yeah.
I've also heard of people negotiating a corporate apartment in the other city, so that was very common.
I negotiated the opportunity to be an investor if they were going for another round.
Yes, that is a great one. I just used that too. That's really nice, right? Because you can invest and double down on things that you're inside and you know the numbers are good. So investing in another round. Anything else?
I just want to make a quick, I think that let's pull data on how much more risky CEO is versus CMO, because we're sort of assuming that being a CEO is more risky. Like, so we should look at just how short their tenures are in comparison.
I'm saying like I can go into an opportunity for $100 million company that has 100% year-over-year growth and
Oh,
take
I
that
see.
role so the equity is less risky than the CEO role I could get at a $15 million company
Gotcha.
that is earlier in its product fit, which is going to make that CEO role
More risky.
the
Gotcha.
equity more risky, not the ability or the
Gotcha.
job more risky.
Gotcha. And then Kate, you commented on supply and demand. Can you maybe just share what you're seeing from a demand perspective out there? I mean, I know we're all getting hit a lot, but I'd love for you to share.
Happy to, thank you. So just to give you some general information, a typical workload for me at any given time is 7, 8 searches. Right now, I've got everything going. I'm at 12, and I'm on the regular asking my clients to wait for me because I simply can't take on another search at that time. Every company that calls me, and it's 100% inbound, every company that calls, one of the first questions they ask is, do you have bandwidth? All executive search firms are maxed out. And this is not just the boutiques that specialize. I happen to have a client who reached to Heidrick and Struggles, one of the largest in the world. That company told an existing client, no, we can't take another search. Heidrick and Struggles. So that's how busy the market is. I've turned more searches down inside of 2021 than I have in the entirety of my career. That's how busy it is. I have not seen a market like this since 1999. No, and I thought, no, I do want to say something because you're not the only person who has that reaction, right? 99 did not end well. We are not in 1999. 1999, the reason why things went bad was in some part because of naivete, right? The internet was new. The growth that we're seeing in the market right now is fueled by multiple things, and the pandemic is one of the catalysts. The transformation, the digitization, massive companies are hiring to undergo massive change, and the small guys are growing. So change and growth, always higher. I'm a big, I probe the CEO on whether or not they truly understand and value marketing. And if I can tell that it's baloney and they just think of it as demand gen, I say, might want to take it down the street. I think also I like to keep a portfolio that is diverse. And what I mean by that is I want to work at any given time with a certain number of startups, a certain number of companies in private equity, which I never did 5 years ago. Today, private equity is a huge portion of my pipeline. Private equity works extremely differently. Not all, some are still bad actors, but there are some fantastic private equity firms out there today that fuel growth and act like venture capital. They are amazing. I urge you to keep an open mind to private equity. And then the other is publicly traded. I want my portfolio to constantly have one of each of those clients at any given time. So the market is intense, and I'm mostly doing CMO searches, but I'm also taking on, VP of, product marketing, VP of brand,
Comms.
and comms, exactly. It's a wild. You guys are the buyers, not them. You.
Kate, best recruiter.
What else I think would be interesting is maybe we should rate the PE firms, because a lot of like your experience is based on them.
I can tell you. the firms that you want to work with.
Yes, let's hear it. Let's hear Nerf guns.
I'm not going to. I'm not going to mention. I'm not going to mention the firms that you shouldn't, because I don't think that that's right. And I think everybody's different, right? Some people love working with Vista; they love it, and some people are like, "Oh my God, kill me!" Right? So I don't. I will just recommend 3 firms that I personally work with, because I think they get it. Sumeru, also known as SEP, um, TPG, and Hellman and Friedman. Hellman and Friedman, they are terrific. And all 3 of these organizations invest in tech, and they all invest only in growth, which means they don't invest in companies that need to be turned around, which means they need marketers. The guys who are turning companies around hire CFOs. They're going to squeeze their way to profitability, right? But the companies that invest in growth, they need great revenue officers. They need great market officers. They get it. So those are the ones you want to work with. And then when you get in there, you're in the family, right? And then you stay. You can either stay in the family and they'll just keep asking you to take on, and then they get you the board opportunities too. It's great. Keep an open mind to private equity.
I think, and Carrie Lou, you may have some of this, but it used to be, maybe it's not now, the way equity vesting works if you're at a public company or a VC backed, and the way it works if you're at a PE is quite different. And for some, and maybe this isn't true anymore, if you're not there at the liquidity event, whatever you think you earned, you don't get. You can be there 4 years and you leave, and 4.5 years they have a little, yeah, you might be out cold. So like really pay attention to the fine
true.
print on your equity if you're going for a PE firm. And it's probably changing a lot, and it probably really changes with the growth oriented versus the turnaround, but pay attention to that one. Don't make assumptions.
We're almost at time here, so do you want to make one more comment? Yes.
Claudia! She's getting her workout.
All right, look at her. So on that vein, when you are, let's say, if you or someone you know is considering moving on, right, from the position you're in, and you vested, how do you determine how do you determine whether you should exercise and buy, right, or just walk away and go? And I get this also from my employees who move on. They say, should I buy my shares or not? And so I know it kind of comes down to your valuation as a company and what is owed to the investors first, and then what you can get should there be an exit. I just want to understand some different methodologies or ways that we can think about that.
I want an investor club. So one of the
Yeah.
jobs I left the day I got so angry at the CFO, and I went out on a walk, and I was like, I'm not going to buy my options. I don't believe this company is going to make money. And the moment I thought that in my head, I thought, now, why is my time less valuable than my money? Why would I stay here if I am not willing to spend the money on this? So I think it's everything about investing. Is it a growth company? Do you believe in the leadership? Is it a leader in its market? Does it have momentum and organic growth and word of mouth and happy customers? And if you sincerely don't believe that's true, generally as an investor, I pass on that. And there's things that I've passed on that are a bummer. I wish that I had bought more Shopify stock earlier than I did, but I bought some good Shopify stock at a good time. And I'm really glad I didn't buy pets.com. I'm teasing, right? But these are the hard things. And what's so annoying about this presentation is you can have all of the metrics, and then you get to the next decision and it's complicated. I had a slide in here that was showing Atlassian and Snowflake. And Atlassian and Snowflake are both super successful companies, and they have totally different models. So when Snowflake went public, their growth rate was like 130%, let's say, and Atlassian's was like 30%. But their profitability was like negative 120%, and Atlassian's was 2%. So we were a super profitable lower growth company or a unprofitable super high growth company, both with high net dollar retentions. And so you kind of take out your calculator and you look at all the math, and then you just kind of got to make a gut call. And that's hard. I want to share one. So we are all investors. Everyone who is standing up who owns equity, you are already an investor. And it's time for us to start thinking of ourselves in that way. And it's time for us to start educating ourselves. And the ways we can educate ourselves, some are harder and some are easier, right? The Wall Street Journal is the #1 business publication for a reason. What was the one with Seeking Alpha is a phenomenal website for investments. When I was at Oracle, I would listen to every Oracle earnings announcement and every one of our competitors' earnings announcements. And I never ceased to be amazed by how much you learn. They tell everything about how the business is going and what they're focused on and strategizing around. And Maria, I've never told you, but on your profile, you took a financial and accounting executive ed from Wharton, I think, one of the 1-week executive eds. And I saw that on her profile at one point and was like, oh, she's smart. That's a great way to be smarter in the boardroom and talk to my CFO. Did you like that class? It was good. Okay, money equals freedom, choice, and impact. And that's what we deserve. And I have one last cartoon in honor of Christine, because we thought our lives and our portfolio were going to be like this. We're just going to get better jobs and enjoy our lives happily as CMOs who everyone likes and where everything is easy. And really, the journey has some really deep pits, and there's alligators in the bottom of that water pit. But if you notice, the end point is actually higher. And I feel like in some ways I've done much better than I expected to do, with a lot more pain than I expected to have. And so I just want to encourage us, because I think this aspect of taking ourselves seriously as financial executives is really important in the C-suite. Thank you.
Oh my God, Carrie Lou. Can we get everyone in the room is going crazy? Can we get some shout outs in the chat virtual, because I'm getting a ton of slacks and things about it, like you brought the house down, everyone wants your slides. I mean, and we'll get the investment club going for sure.